Right, so we are going to start with pips, okay? Pips and then pips calculation. It's very important we understand that because if you remember from the introduction, I said that as for pips, we use it that term pips. We use it every single day. Even today, I used it. Okay, so it's something that you are going to live with. It's important you understand what it is and then how to calculate it. Of course, our systems do the calculations and stuff for you, but it's still important that at least you know the basics. Okay. Okay, so we said that a pip is the smallest change in currency value, or it is the unit change in currency value. Okay, a unit change, when we talk about a unit, just one. Okay, and then remember we said that so a pip and a pip is equal to 0.001. If you remember from our first meeting, I think I even did the recording yesterday and I shared it on the on the various platforms. Please mute your microphone for me. Thank you. Right, so a pip is equal to, who is that? If you can hear me, kindly mute your microphone for me. A pip is equal to 0.0001. And this evening we will get to understand why it is so. Okay. Now watch here. You see that this chart is moving, and then you can see some dotted lines drawing all the way to my right side. And you can see a reading here as 1.16694. Okay. Now omit the fifth digit, count up to the fourth digit. Okay. So what it means is that as we are speaking this evening, right now, okay, the euro to the dollar is equal to 1.1669. That's what it means. Okay. The euro to dollar is equal to this. It means that if you are holding 1 euro, it's equivalent to what? 1.1669 US dollars. So if I should quiz you just now, which of them is bigger? Which one is bigger? I want to believe that we all know which among them is bigger. Yeah. So definitely is the euro. Okay. So 1 euro is giving you 1.1669 US dollars. Okay. Now the feet digit is a micro change, so we don't use it. Okay, so we count up to the fourth digit. And remember I said the pip is equal to 0.0001. What it means is that if this value, what we have here, 1.1669, if it changes to 1.1670, what it means is that it has changed by what? 1 unit. And that is equal to what? 1 pip. So it means that it has changed by 1 pip. That's what it means. And this is where we get the money, or this is where we make the money. Okay. All right, you will get it. So if it changes from 1.1669 to 1.1679, how do you find the difference? Just subtract this from this and you realize you are going to get what? 0.0010, which is equal to 10 pips. Okay, is equal to 10 pips. Now, so I'm going to put equal to here, 10 pips. Now, is the 10 pips that's going to translate into money? What all of us are interested in, the reason why we are here. This pip is going to translate into it. So we are going to understand how that is done. So that will take us to what we call lot size or lot sizing. Okay. Now we have three main types of lot size. We have the standard lot size. Okay, standard lots. And then we have the mini lot, and we have the micro lots. Okay, we will understand what they mean. Okay, right. So if you are using the standard lot, it means that you are trading 100,000 units of that particular currency or um financial instrument, because it may not be a currency. That's why. So you can call it an asset. So if you are using the standard lot, it means that you are trading 100,000 units of that particular asset. If you are using the mini lots, it means you are trading 10,000 units. So here we say it's what 100,000. So you let me make it 100K. Okay. And then the mini lot is 10K. That's 10,000. And then the micro is 1K. Okay. Now, this translates into $10, whilst this translates into $1, and then this translates into $0.1. Okay. So what do we mean? We mean that if you use the standard lot size, which is equal to 1.0, so the standard lot size is actually equal to 1.0. Okay, don't worry, you will understand that when I'm done here, I'll show you how we can see all these things on the trader app. Okay, so don't worry about that for now. It means you are using what 1.0 lots, and then the mini lots is also equal to 0.1, and then the micro is equal to 0.01. Okay, so when you set your lot size to be equal to 1.0, it means that you are using the standard lot size. What this means is that per every pip, per one pip each, you are going to make what? $10. So see, this example I gave here, I said that let's assume that euro changes from 1.1669 to 1.1679, and we have agreed that that's equal to 10 pips. If we get this difference, how much this is in dollars is it depends on the lot size you are using. So if you are using the standard lot, you are going to multiply this difference, which is 10 by $10, and that's equal to what? $100. So it means that if the market changes by just 10 pips and then you traded it with the standard lot size, you are going to make what? $100. If you traded it with the mini lot size, which is equal to $1, you multiply 1 by 10, and that's what? $10. If you traded it with the micro lot, which is equal to $0.1, that's equal to what? You multiply this by 10 pips, and that's equal to what? $1. So the same number of pips, the standard lot is giving us $100, the mini lot is giving us what? $10, and then the micro lot is giving us what? $1. What does this mean to a trader? It means that if we are trading and I use a bigger lot size, I'm going to make more money should the market go in my favor or our favor. The same way, if the market should go against us, I'm going to lose more money, because assuming there's an appreciation here, assuming you went for a sell, as in you predicted that the market was going to fall, and then that didn't happen, it means it has gone against you by 10 pips. Same way, if you use the standard lot, you have lost $100. If you use the mini lot, you have lost what? $10. And if you use the micro lot, you have lost just $1. So if that is the case, is it advisable that we trade with only the micro lot or the mini lot or the standard lot? So that would depend on what the capital you are trading with. So because if I'm trading with $10,000 and then I'm using the standard lot, if I should lose 10 pips, that's just $100 out of my money, and it is still significant. I can pick good trades. If you are trading with $100 and you make this mistake, it means if the market goes against you by just 10 pips, your money is finished. You understand? So you cut your quotes according to your size. That's it. However, when you start practicing, I'm going to give you the recommended lot size that you should be using so that you wouldn't make the mistake of using the wrong lot size. I do this with all the classes, and so you have people doing their own thing. You see them trading with the standard lot. Soon enough, they blow their demo account. If you are blowing a demo account of $10,000, you can ask yourself how much, what are you going to do to your $10, your $100, your $500? Okay, so let's learn this, understand it, and then stick to it. Okay. All right. So that is enough for the lot sizing. Okay. That's enough for the lot sizing. So the next thing that I want us to look at, it is very important. What I'm going to show you now is going to determine whether you will be a profitable trader or not. And I want to believe that all of us here want to be profitable traders. So let's pay attention to what I'm going to share with you. Yeah, so if at any point my network disconnects or you can hear me, just call my number on WhatsApp. Call me on a regular call or something so that I check and then connect back. Thank you very much. So the next thing that we are going to look at is what we call market structure. Market structure. Okay, we are going to look at what? The market structure. And I want to believe that we understand it. Even before I explain, we understand when we to say that we want to describe the structure of a thing. Is either we say it is big, it's small, rounded. I mean, the physical appearance, how it looks like. Okay. So the market structure, we are talking about how the market looks like. So it is whether the market is what, going up or going down or ranging or choppy. Okay. We'll get to understand it. So we have three main types. We have trending. We have trending market, and under that we have uptrend and then downtrend. Okay. Then the second one is ranging market. Ranging market. And then the third one is choppy market. Market. So this is the thing. We are only going to trade this and then that, the trending market and the ranging market. This one, we will stay away from it. It's a big no, this one. We don't go near it. Yeah, I'll show you a reason why we don't do that. So it's either the market is trending. If it is trending, it means it's either going up or going down. If it's not doing that, then it may be ranging. Ranging means that it is going up and down, following the same routine within a specified region. Okay. And then when we say it is choppy, it means that it isn't giving you any proper figure. You are not seeing whether it is going up or going down or moving within a specified range. If that's the case, then it means it's choppy. And from the explanation, you should even understand that you shouldn't trade such market because it's hard for you to predict the next movement, where else it will be going. And for that matter, we leave that. Okay, we leave it. All right, so let us now look at how they look like. Okay, the trending markets. Let's see how they look like. So I'm going to show you how an uptrending market looks like. So I'm going to first start with a sketch. After that, we will look at the real market. That's why I said that this is going to be a bit in-depth. So it's good we are all present so we can ask our questions. So when the market is going up, we expect to see something like this. So we expect the market to move from lower region to higher region. We expect the market to be appreciating in value. How do we know that? If I look at my cursor, if I put it here and I trace the price to my right, you see that it is 1.1564. If I go to the top here, it's giving me 1.1738. Definitely, this price is what bigger than this one for that matter. This is what an uptrend. It means that that particular market has appreciated. It has increased in value. That's what it means. If a market is in an uptrend, what do you do as a trader? You buy. You buy. If a market is going up, you buy. Let me give you an example. when you hear that the dollar is going to depreciate, okay, that is the city is going to strengthen, what do you do? The city is going to strengthen. What do? You buy more of the dollars down. And what do? You wait. When the city starts depreciating, as in when the dollar starts going up, you sell your dollars. And that's only when you make money. What do I mean? Let's say the dollar currently is, in fact, that's the stance now. The dollar is trading at 10.7, what do you call it? To see this, $1 is equal to 10.7. Okay. If you know that it is going to increase in the future, right now, what you can do is that buy more dollars down now that it is at what 10.7, so that when it eventually goes up, let's say it goes to 12.5 or 12 point something, you sell it at that price. When you sell it, because you bought it at 10.7 and you've sold it at 12.5, that difference is going to be what? Your profit. And in fact, that is basically what we do here. That's the same thing that we do here, only that here the assets are online. Okay, so you're not going to get them physically. They're like you walk to the bank and then buy some dollars. No, they are online. Okay, so that's just it. Same way, if you think that um the market is going to go down, what do? You sell. So let me explain the ideology behind that. So let's say you are using iPhone X Max, okay, and then say you bought it at 3,500. Then you heard that Apple is going to release a new version of an iPhone, okay, which is higher than yours. If you have noticed, anytime they release new versions, the old ones, the prices go down. If you have paid attention to that. So you know that, okay, then if the new version comes out, my phone is now going to be worth somewhere around 3,000. If that is the case, if you want to take advantage of the market, this is what you do. Go to the market, go and sell your XS Max to someone at 3,500. As at the time that you are anticipating that the price can drop in the future. Then when it finally drops, to 3,000. Go back to the market, buy your phone back at 3,000 cedis. Now you have your phone and then you have extra profit of what? 500 cedis. So that is how we make money from the market. So we either buy when we think price is going to appreciate, or we sell when we believe that price is going to depreciate. And either way, we can make money. And this is the advantage that we have over building any business. Because if you establish your own business, the only way you are going to make money is when you start making profit, when your business starts growing. However, over here, even when the market is going down, you can still cash out. When the market is going up, you can still cash out. But you should understand it well. Where exactly should you buy? When should you buy? And where should you leave? When should you sell? Okay. And that's the purpose of the lesson. After the whole training, you should be able to understand when and how to do all these things. Okay. Right. So for the downtrending market, it also moves like this. So it starts from the top. It starts from the top and then it descends. Okay. From the top, it descends. From the top, it descends. Something like this. So that one also goes down like this. Pardon me, I didn't mention something here. It's very important. It's something that I'll be asking you from time to time. So this is it. You see, when the market is going up, you see that it goes up and then it comes down. It goes up and then it comes down. Where it gets to before it goes down, we call it higher high. Okay, we call it higher high. So this is called higher high. This one, I mean here, it's called higher high. And then where it picks up the buy is what we call higher low. Okay, so we have this higher high, higher low, higher high, higher low, higher high. So as it progresses, it keeps forming higher highs, higher lows. So I'll give you assignment maybe in the second meeting or the second training. I'll ask you to go and identify the structure of the markets. Then you come and tell me that it's an uptrend. I'll ask you, why do you think it is an uptrend? You should be able to tell me that it is because the market has formed series of higher highs and higher lows. Okay. Now, if the market is in a downtrend, it rather forms what we call, sorry, it forms lower lows and then lower highs, lower highs. Okay. So when the market is in a downtrend, that's when it is dropping in value, it forms lower lows and lower highs, lower lows, lower highs, lower lows, lower highs, lower lows. So when we start with the practicals, and then I tell you that a particular market is an uptrend, you should know why it is so. Okay. I want to believe that we are following, and this is not difficult just yet. Okay, so you put your questions down. I'll take my time to explain it to you. Now we have tackled just this one. Let's look at a ranging market. So for a ranging market, this is what it does. It moves within a specific zone. Okay, it moves like this. So this is how a ranging market moves. Okay, so you can see that all the highs are around the same region, all the lows are around the same region. So we call this these sides, okay, this we call it equal highs. Okay, we call them equal highs, and then we call these ones equal lows. Okay, so if you tell me a particular market is ranging, you should be able to go on to tell me that it is because you can identify equal lows and then equal highs. All right, this is how a ranging market moves. Now for the choppy markets, like it moves in a very irregular manner. Okay, you can't really tell if it is ranging or it is going up. Whatever it is doing, you can't really tell. Something like this, like it's just clumsy. You can't really tell what it's doing. Okay, sometimes it can even give you an outlier like this. Okay, it's very, very irregular. Something like this. So you see that this one, sorry, the market doesn't go back. Yes, so this is right. So it happens like this, something like this. Okay, so you see that you can hardly tell whether this is an uptrend or a downtrend or whether it is ranging. Because of that, in the choppy market, we don't trade. Okay, we don't trade the choppy market. That is fine. So now I'm going to take you to the real markets. Then I'm going to show you what an uptrend look like, what a downtrend look like, what a ranging market look like. And if we see or we find any of the choppy markets, we'll look at that as well. Then when we are done, we will start what we call the basic um, support and resistance marking. Okay. And I think that will be the end of our lesson. Okay. So I'm going to take this off. Don't worry, if you ask your question and it has to do with this, I'll bring it back. Okay, so this is what we are going to do. We are going to try to see if we can identify the trend of the markets. We're going to see if we can identify the trend of the market. All right, so I'm not going to quiz you just yet. I know that some of you, from the explanation, can tell me the trend of this market. However, I'll go on to say it anyway. Now, this is an uptrending market. The reason is that we can see price started from this lower region and now it is here. It's up there. Okay. So it started from here, a lower price, and now it is what? At a higher price. So this is an uptrend. That is one way to tell. Another way that we can tell, remember the sketch that I did, is that we can find higher highs, higher low, higher highs. Remember that higher low, higher high, higher low, higher high, higher low. You see, and then on and on and on it goes. Higher low, and then excuse me. I hope it's not here. Please, can you still hear me? you can't see my screen. Who is that? Please, can you see my screen? Okay, okay, okay. So I think that the problem is from your end, Manuel, and then Bernard. Check your network. Okay, it's not from my end. Kindly check your network. Thank you. Someone was calling. I thought maybe I was off, so you were calling to prompt me. Let's continue. All right. So you can see the higher highs, right? Higher high, higher low, higher high, higher low, higher high, higher low. In fact, don't worry if you are not getting this. It took me more than 3 years to understand this. But then I will make sure to simplify it so that you get it. Okay, it shouldn't take you more than a month to be able to read this. Yeah. So this is how you identify that a particular market is in an uptrend. So you see higher high, higher low, higher high, higher low, just like that. Okay. So then this is what an uptrended market. We can conveniently say that this is what an uptrended market. Okay. Now let's see if we can identify when the market was dropping. Hmm, I think this was coming from one of my classes. Okay, so there's an interesting thing here. Let me take it off. Yeah, there's an interesting structure here, and I want to believe that we can all tell the type. Okay, this is what a downtrend, because see, market from this higher level drop all the way here. Okay, I'm just emphasizing on up to this point. So this is what a downtrend in market. It was dropping in value. So in this case, we sell. We'll show you how to sell and where to sell. So look at it. So this one was the last high that formed. Then a zoom to a lower low, then a lower high, a lower low, a lower high, a lower low, a lower high, a lower low, a lower high, a lower low. You see it as it goes. You see it, right? I want to believe that we are all on the same page. I'm not talking to myself. Yeah. So that is just it. Okay. So you see that the market is forming lower lows, lower high, lower lows, lower highs. Yes. And so this tells us that this is what a downtrending market. And in this market, what we do is that we sell. Okay. What we do is we sell. All right, so now let's try and see if we will find the other structures so that we will identify. So for the ranging and then the choppy, doesn't really happen much in the market. So sometimes it's hard to identify it. However, this side this this part it tried to consolidate, so you can see that we have one two like equal highs here, we have one two equal lows here, right? So this part was trying to range, so this side was ranging a bit. Like I said, it doesn't normally form in the market, so it's kind of hard to identify it. Yeah, even here, I think the same thing was happening here. So it was trying to range within this zone. Yeah, so we have the highs here, these ones, and then we have the lows here. So this one too. So for the ranging, you will see it more often compared to the choppy market. So I'm trying to see if we will get any choppy market. All right. So here it was kind of consolidating because here you see that this high is not the same as this. It's not the same as this. It's not the same as this. Okay. This one is even higher than this. So here it was a bit irregular. However, the bottom tried to give us equal levels, but this doesn't qualify as a ranging market. So here it consolidated for a while. Okay. It consolidated for a while. But then don't bother about that because I said we are only going to trade the trending market and the ranging market. So see over here, you see a nice downtrending market, and I can identify my lower lows, my lower highs. I can easily see them. I can easily see them here. All right. And then I have you see the uptrend here, higher highs, higher highs, higher highs, higher highs. Okay. And then a downtrend. All right. So this is what we are going to do. We are going to do what we call basic um support and resistance marking. Basic support and resistance marking. Okay, so that's going to be the basis of every analysis that we will do. So I'm sure you remember from the first lesson, I mentioned something about technical analysis. We spoke about two types, the fundamental and then the technical. And then we said that the technicals has to do with price movement, the direction. We said we can use trend lines. We can also use basic support and resistance. So we are going to learn how to mark the support and then the resistance. It's very easy to do. It is very easy to do. So I'm going to do one right here for you. Okay. So this market, like we can all see, is what in a downtrend because we can see that it was dropping all the way to the bottom. So remember, I said when it is selling or when it is dropping, it forms series of lower lows. So your task is to identify the lows and then mark them. So I see this low here, I've marked it. Then I see this one here, I mark it. I see this one here. So remember I was doing lower low, lower high, lower low. So it's the lower lows that I'm targeting here, here, here. Okay. Then I have one here. And then let me skip. And then this one. So this is a lower low. This one is a lower low. It's also a lower low, and then lower low. Now, the levels that we have marked are what we call resistance levels. The levels that we have marked, they are called resistance levels. So what do we do? Whenever price gets to the resistance level, we sell. Whenever it gets to it, we sell. Whenever it gets to it, we sell. Whenever it gets to it, we sell. Okay. Until it fails, because market is not going to sell forever. It's not going to buy forever. So at some point it will fail. Yeah. So that's why you need to protect your account, stop loss and take profit. Remember, first lesson. Okay. So this is how we mark the resistance levels. Identify the lower lows and then put your bars there. Don't worry, there's a video on how you can navigate this platform where you are going to pick all your tools from. You'll find it in the video. So you just follow it and then you'll be able to do the analysis. Okay. So this is for a sell market. So let's try to find a buy market and then analyze it. So I can mark this as well. I can mark this lower low here. I can mark this lower low. This is a downtrend. And then I can also mark this lower low. So you can see the lower lows forming in here. Let's see if we will. All right. So I want to move all the way to the current market. And then we see what we can do with it. All right. So we were looking for an uptrend. Okay. We're looking for a market that is going up. And over here, you can see that the market is going up here. So what do we look for? The higher highs, right? Higher high, higher low, higher high, higher low. I mentioned higher high, higher low. Good. So let's go. I have my higher high here. So I mark it. I have this one here. Then I have this one too. I have this as well. And then I have this. And then maybe the last one I'm going to have to. No, in fact, this one is also a high. This one. Okay, so I'm going to show you, so this side. Okay, so how do you take advantage of it? When you mark the level and price breaks it, it comes back, you buy. Breaks it, comes back, you buy. Breaks it, come back, you buy. Okay, that's what you do. So the levels you've marked are support levels, and then we buy from the support levels. This is the basic way you are going to do analysis. There are several ways to do it, and I'm going to teach you most of them. Okay, but this is the very basic. So if you don't understand this one, um, you have to set up. Okay. Other than that, the other ones you will find it difficult to understand. And that's why we are here to help you. Okay. So you identify the support levels. Yeah, and for the ranging, I showed you how it is two markets. Okay. And then for Choppy, we don't trade it, so you can let it go. All right. So this is how simple it is to do the markings. All right. Now I want to um, explain further how you can identify it with ease. So you see that some of the candles are white, some of them are black. So most of the time, the highs or the lows, they are formed where the opposite candles are meeting. Okay, where one ends and then the other starts. Most of the time, you can identify a resistance there or a support there. So if you look at it well, this level, let me place it well, you can find a bullish candle here, the white one, and then the black one. If you look at this one, the same thing, the white one and the black one. If you look here to the same thing. So what am I trying to say? If I ask you to go and do your markings, don't come here. You go and be marking candles, like bullish candles, you mark them and you send it to me. A lot of people do that. That's why I'm showing you how to do it and do it properly. Don't worry, about 70% of the training will cover this thing. Okay, so you will get to understand it very well. Today, we are just introducing you to how it is done. Remember, we are meeting on Monday as well. So Monday, we are going to do more in-depth analysis, more in-depth analysis. So on Monday, we will learn how to place the bars well, and then learn how we are going to take the trades. Okay. Then we will learn how to set stop loss and then take profit. We are going to learn that on Monday. So for today, I explain what pips are, I explain what lot sizes are, and then I explain the market structure. We have three types: the trending, the ranging, and the choppy. And that trending, we have uptrend and a downtrend. Okay, and we have looked at how we are going to mark them. Remember this: if you don't remember anything at all, remember that if you are in an uptrend, you are going to look for buys. If you are in an uptrend, you are going to look for buys. If you are in a downtrend, you are going to look for sells. If the market is ranging, buy from the support and sell from the resistance. If it is choppy or consolidating, let it be. Don't take any action at all. Now, let me explain why we buy from the support and then we sell from the resistance. So take the resistance as your roof, okay? The ceiling in your room. You see, if you are to throw a bouncing ball at it, once the ball hits it, what will happen? It will drop down, right? It will fall to the ground. Once it hits it, it will come down. So gravity will act on it and then it will come down. Same way, if you hit the floor of your room, if you hit it with a bouncing ball, the ball will go up. So basically, the support is serving as what? The floor. So anytime the market hits it, it has to jump up. And your resistance is serving as what? The roof of your room. Anytime the market hits the resistance, it has to drop. If you understand this, once you're able to mark the levels, you know exactly what to do, whether to buy or to sell, because you know your levels. You know the difference between support, you know the difference between and then what resistance. So you know exactly what you are going to do. Okay, so this is what we were supposed to cover today. The next thing is I'm going to show you how you are going to take the trade, how you are going to close the trade, and then I think the stop loss, the take profits, we will do that next week Monday. Okay. So give me that one wouldn't take much time. Give me about 5 minutes. I'm going to join with my phone and then look at it. Yeah, I'll give you a chance to ask your question. Don't worry. I want to do this first. Okay. I'm going to show you how to buy, how to sell, and then all that. The lines that I've shown you, you have to know where to pick them from. Yeah, so after that, I'll give you the chance to ask your question. So remember I asked you to um open a demo account, and I want to believe all of us on the call we have a demo account. So after here we can start um practicing. Just give me like 3 minutes. Mm.